Welcome to Centaur Financial Services podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Hi everyone, welcome to the second instalment in our retirement series. Thank you for the feedback for the first one. That was excellent, and it's something that we really want to produce more content for you to help enable a better retirement and more peace of mind and give you that really pass that sleep at night test. Today we're going to talk about 6 ways to get our money into superannuation, something that really we don't understand. We find a lot of people don't understand well enough all the tips and traps around how we can get more in, because we do understand that super is pretty much the best investment vehicle we can all take. So today I've got Anthony Mirandilla with me. Nick is off sick today, which is kind of funny since he's the only one without kids. Yes. He gets sick the most, but we won't go there. No. So let's start off today. We're going to kick off with the 6 sort of simple and effective ways to get money into super. Let's start. I'm going to start off with the regular employer contribution. So for all of us who are still working, remembering that that's gone up to 11.5% of your salary this year. So every time you get a pay rise, not only are you getting more in your money, but you're also getting more in your super. And next year that goes up to 12%. So really important, if your focus hasn't been on what your contributions are doing, it's really important to make sure that it's aligned in the right risk profile. So have more growth investments than defensive investments, especially in the lead up to retirement. This is crucial and something that every client that we see, or potential client that we see, usually their money might be in a life stage fund where someone else has decided that you shouldn't have a lot in growth assets and more in defensive assets. Obviously with defensive assets, cash and fixed interest, that grows a lot slower than shares and property. While we're still accumulating, we've got that money going in. We want to be buying more shares and property, as that will compound a better outcome for us over the next 5 to 7 years. So I think that's a really key point, knowing that there's more going into superannuation for you, get it working harder for you, being in a better risk profile. And if you're worried about the risk, that's always talk to us about volatility and how to manage it. Markets will always be volatile. Everything is volatile in this world. It's just how you manage the risk so we can get that great outcome for you. So that's making sure your employer is paying. Over the next few years, it's going to be that when your employer has to pay, with your regular pay cycle right now, they can pay quarterly, which the majority of employers either pay quarterly or monthly because it's easier for them for their payroll. So just check on your statements that your money is actually going into not only super, but the right super fund. The other thing I would say that when we are now talking about more money going into super is checking our insurance premiums, making sure that insurance has gone up and up and up over the past few years. If your insurance is in your super fund, just check that you've got the right amount of cover that you need. There's no point paying for cover that you don't need, because it's definitely going to impact your retirement if you're spending more on your premiums every year.
I think the big thing there is just to make sure you're taking control of your super fund and what it's doing and what the expenses are, but importantly just being aware of what's happening within your super fund.
I think that's a great point. So now we've got the employer putting money in, which is great. What are the ways that people themselves can put money in?
Yeah, there's probably 3 main ones here that we'll talk to. And I guess just as a quick note, I just did a couple numbers on, especially when we talk about voluntary contributions, just a 1% increase on what your employer's already putting into superannuation definitely has a big impact. Like, I just did a quick scenario, $100,000 income, where we're currently doing 11.5%. If you were to increase that by 1%, you would get an uplift over a 30-year period, on the assumption we're 30, so a little earlier in the accumulator space. But it's almost an $100,000 difference. It's around $92,000 that should actually improve your superannuation balance during that period, which is a significant difference. And by doing so, it's almost a set and forget plan. And there's a certain few ways we can do that. It's salary sacrifice, where you commence an ongoing arrangement with your employer, whereby you'll be starting off those, whether it's the frequency is either fortnightly, weekly, monthly, based on your pay cycle, making pre-tax super contributions to your super fund. The main benefit of that is, rather than paying, as an example, on a $100,000 income 30%, your superannuation contribution would then go in at 15%. So straight away there's a 15% better position, and as a result we're also investing for our future and retirement planning. The second one to note though is you can also do them as a pre-tax payment, either via just before June 30 in the financial year, or again that regular payment, and it does depend on your personal circumstances. To give you the example, some of the small business owners that we sort of work with at the moment, they'll work with their accountants and will make a determination closer to the end of the year based on what's the right approach for your super contribution. Or alternatively, if you're sort of better structured on your cash flow and sort of know a little bit more, then commencing that regular payment. And all this is just that for savings. We want to maximise what you're doing with the super contributions, with the cash flow that you've got, and making sure we're hitting those targets that we need to.
I think the big example of where we see that, in addition to the small business owners, is when someone sells a property.
Yes.
And we want to manage the capital gains tax.
Yes.
So make sure you don't enter into the contract for sale prior to a financial year and then get the proceeds after. That's always problematic in the next financial year. But always that's how you can get big lump sums into money. So we've now got that, that non-concessional cap, which is you don't get a tax deduction for it, but it doesn't pay any tax on the way in, of $120,000 per year. Or you can bring forward 2 years, so that's $360,000. Or there's the concessional cap, which includes our salary sacrifice, our SGC, the super guarantee that our employer puts in, and that's up to $30,000. So that's gone up. A lot of people come in sort of saying, I remember the cap was 25, I remember it was 27.5. It does index, so it's now 30,000. And it's a really good way of getting an additional tax deduction for you straight away, but more importantly, building that long-term compounding engine that is our superannuation.
Yeah, one of the things I see is people where they either get an inheritance or whether it's even just a bonus, the annual bonus, and depending the time that you get that. But there's the opportunity to make that lump sum and utilising that $30,000 cap that we've got at the moment to get as much as you can into super, but at the same time get the tax savings associated with it. So the next part, I guess, in terms of what we wanted to go through was around the government co-contribution. I think what we wanted to take into account here is there's a certain few things that we need to make sure we're doing. So each and every year when you pay tax, there's sort of a limit on what we can do here. So it's up to a cap of $60,400 in terms of what you can earn. But when you do that, you've got the ability to use this government co-contribution. And what in essence that is if you made a contribution of up to $500, then you could get a co-contribution met by the government. And what happens there is it's provided back to the super fund that you've put your super contribution into. And this is done after you've finished or finalised your tax return. And one of the main benefits of this is some people use that for the purpose of their insurance premiums that are being charged to the super fund. But importantly, over that long-term period, there's some big gains. And if I touch on Hugh's comment around compounding, we're then using the government's money to then compound within the super fund, and especially over a longer time frame, we really get some good outcomes in terms of what we want to do with your super fund over that time.
Love it. And I think it's always these little things seem little at the start, but like the snowball, once we get a compound, and it does really help. So you've got to look if you can do it. And even if you earn too much money and you can't do it, maybe your kids can. So just introduce these topics to them. Let's help them get their financial literacy up to date so that they can get these free kicks. It's a nice little boost. Who doesn't want something free from the government?
And there's another one on that too. It's called the spouse contribution. So for couples where there's a income earner that's slightly higher, as my previous example, if you're earning $100,000, but if your partner's only earning $37,000 or below, but still making that tax return, there's the benefit of utilising this spouse contribution. So how that one works is you can contribute up to $3,000, but instead of receiving a tax deduction for these contributions, you actually receive a tax offset. And again, it's just making the most of the legislation that we've got at hand to again continue building your super funds towards your retirement goals.
I like that one. Downsizer. So this one, probably people don't understand that there isn't actually, the lower age limit is 60. Used to be 65. Now it's 60. Or is it 55?
55.
Might be 55 even. You can contribute 300,000 into super. It goes in there as a non-concessional, so it doesn't pay tax on the way in. And you can do it for both spouses. So if you've lived in a home, if you're 55 or over, you've lived in the home for more than 10 years and you sell, because the kids are all growing up and out of home, you can now get up to $600,000 into super if you're a couple, 300 out if you're a single, and that won't impact your concessional cap limits. So in many instances, clients get well over $1 million into super if they wanted to, if they're really doing this downsize. So there was a lady named Eleanor Dartnell that got this into legislation years ago, a financial advisor. And it's been one of the best things and something that we really want to advocate this to every client to understand that you can do it. So if ever there's no work test requirements for it, it's just if you've got the money from sale of a home, and I think there's about 90 days that you've got to get the money into superannuation.
I believe as well on just on that, mate. There's circumstances where you can get an extension as well. So for unforeseen circumstances that we need to get that extension on the 90 days, you can definitely apply to the ATO, and I've sort of used that for a couple of people just to make sure again we're maximising what we're doing for those super contributions.
That's great.
Yeah.
So with these strategies, we've really been able to boost people's super a lot more. From a life admin perspective, what about consolidating super accounts?
Yeah, look, I've mentioned insurance premiums before. Unfortunately, when you did previously sign up to super funds, there was risk, you took on risk whereby you took on the life insurances that came with those, and they were automatically accepted. We all just got them. And sometimes holding multiple superannuation funds, you can have multiple life insurance policies where you're paying unnecessary insurance premiums, which again can have an impact to your super fund balance, not just now, but importantly over the long-term period as you head toward retirement. So just being aware of that, and again, coming back to Hugh's first point around taking control of your super funds, just having a look, getting the right advice, considering rollovers, and consolidating. But an important point, making sure you're getting advice, because sometimes you may need to keep those insurances.
Yes.
There are risks whereby people just hit the consolidate button on the ATO portal that we can now do, and unfortunately they lose out on important insurances that they may actually not be able to get again. So just being aware of those things, but importantly, it's reducing fees, it's reducing insurance premiums, and again, it's just being aware of everything regarding your super balance as we need to when we're approaching retirement.
I think that's great point. We want to reduce complexity in our world, whether it be from an administration point of view, just everything. We just want to strip through the layers of complexity to just focus on what matters and what's meaningful. So, from our point of view, if there's one source of truth, one super fund that you're evaluating, you can make better decisions, and we can always change investment options in the super fund. We don't want to, compare the pair. We just want one and work it as to the best of our ability. So with that, we've got our 6 ways to get more money into super. Episode 2, done. So from our perspective, I think Anthony's point and my point is around take control of this stuff, work in conjunction with your advisor to make sure, we're optimizing it and see what strategies are available to you. Obviously, if you still have debt on a home loan or something like that, there's going to be another conversation. The insurance is going to be another conversation. Downsizer might impact an estate plan. So there's always, this is just the tip of the iceberg, but there's lots to always have a conversation with us about. I think another key point is making sure we're in the right level of risk. We're taking the appropriate level of risk to achieve your goals. And with markets, you always have to be an optimist. Last year we wouldn't have blamed anyone for selling out. We keep talking about this because the narrative was that it was going to be very negative, and it turned out to be a really great year. So we've got to be optimistic. You've got to it's a great philosophy in investing because we know over time the market always goes up. They are just volatile. So that's normal. So with that, we will close it. Please send through your feedback to clients that did send feedback. We loved it. Thank you very much. And if there's other topics you want to listen to, let us know. And next time, Nick will join us, hopefully.
You will.
Right. See you. Bye.
Thanks, guys.